If you are looking for a credit score that gives you a strong chance of credit approval at favorable terms, shoot for an 800 credit score. This score is not perfect, but it places you in the exceptional credit score range, that is highest tier of eco scores, which are used by 90% of top lenders. Having a 800 credit score or better is fairly uncommon. Only 23% of all consumers have FICO scores of 800 or higher. If you are among this group of high credit scores, excellent work. You have shown lenders you are exceptional borrower with a significantly higher credit scores than the average consumer credit score of 714. If your credit score is not there yet, this guide will help you understand that what it means to have an 800 credit score, the benefits of exceptional credit, and how to achieve this top level credit score. What does it mean to have an 800 credit score? An 800 credit score does not guarantee your approval for credit products or the best terms available. That's because the lenders consider other factors besides your credit, including your income, employment history, debt. Still, lenders are less likely to deny you credit due to your credit because an 800 credit score demonstrates that your history managing credit is nearly flawless. Having an 800 credit score means you have done everything possible to prove your credit worthiness. You likely have a legendary credit history. You have made all your payments on time. You only use a small percentage of your total available credit, and you have a good mix of credit. You clearly have a good credit habits, and most lenders view you as a safe bet. The benefit of achieving exceptional credit score. Being a member of the 800 Club might help you gain access to lower interest rates and other perks, including better credit approval odds no matter what type of credit you are applying for. It may be comforting to know 800 credit score likely to exceed any lender's minimum credit score requirements as long as you meet other eligibility requirements like income, employment, stability, your odds and approvals high. Better credit offers. An 800 credit score significantly boosts your chances of snagging best credit cards, including cards reversed for people with excellent credit. On top of that, you are also more likely to be accepted for mortgage, auto loans, and other lines of credit. Lower interest rate. Because you have a proven record of managing credits, you may receive an interest rate offer that are among the best available. Low interest rates can save you hundreds or even thousands of dollars on mortgage, car loans, credit card balances, and personal loans. Higher credit limits. When you have a 800 credit score, you will gain access to higher credit limits, which improves your purchasing power. Another perks of high credit limits that may help you keep your credit utilization ratio low, which helps to maintain your stellar credit score. Better insurance rates. Most states allow insurance providers to consider out your credit score when they calculate your insurance premium, unless your state restricts credit-based insurance scores. Your near perfect credit could help you get a lower premium on homeowners or auto insurance. How to get an 800 credit score? How hard it to get an 800 credit score? It's not as difficult as you might think, although it does require you to take smart steps to improve your credit, including paying your bills on time, every month, every time, Perhaps the best way to show lenders you are a responsible borrower is to pay your bills on time. Payment history is the most crucial factor with the FICO credit scoring models, accounting for 35% of your FICO score, so it's essential you pay your bills on time. Fortunately, if you fail to pay a bill by the due date, you can correct the mistake and stave off negative consequences to your credit score. Typically, lenders don't report missed payments to the credit bureaus until they are 30 days past due. So make sure credit utilization is the second most influential credit score factor. Your credit utilization ratio, also known as your balance to limit ratio, reveals the amount of credit you use compared with your total credit limits. For example, if you have 1000 balance on a credit card with the 4000 limit, you have a credit utilization ratio of 25%. Keep in mind that your utilization percentage is calculated for each credit card individually as well as collectively for all credit card accounts, while a rule of thumb for avoiding a serious hit to your credit card is to keep your card utilization ratio under 30%. Consumers with a credit score of at least 800 have an average utilization ratio of 11.5%. Number 3, be mindful of your credit history. How long you have managed your credit card 15% compromises 15% of your credit score. Typically, the longer your credit history, the higher your credit scores. Credit scoring models may factor in the age of your oldest account, the new account, and the average age of all your accounts. So before you close credit account in good standing, make sure weigh the potential consequences. First, closing the account could reduce the length of your credit history and your overall credit limit, which could hurt your score. If you want to close a credit card you are not using to avoid its annual fee, consider asking your card issuer to downgrade you to a card with no annual fee instead. Number 4, improve your credit mix. You might benefit from an additional credit account, especially if it's a type of credit you don't already have. For example, if you only have installments loans like a car loan or personal loan, adding a new credit card can help diversify your credit mix, which determines 10% of your credit score. And by adding to your credit limits, you may also reduce overall credit utilization ratio. Number 5 and final point, review your credit reports. If your credit score is not what you would like, it's possible it's not your fault. Your credit report may contain inaccurate information which could be harming your credit score. It can be beneficial to review your credit reports regularly for incorrect information and disputes the error with the lender who reported in the information to the credit bureaus.